Welcome to Monday Night Live, the weekly training that guides professionals to financial prosperity. Join our community and let's start building your wealth.
Tonight's subject is like, as I was just speaking of, so this is the beginning of class. Scott Smith is on through some personal and / business connections in a conversation that he and I had a month or so ago. So really, as I just mentioned, pertinent, relevant subject. And I think the way the market is right now, and who knows where it's going to go. I mean, it's just, again, as soon as you think you have the world figured out, the world changes. So go figure. But this is another tool in your toolbox that you can use to help people, for one thing, invest in real estate. It gives them another option, another channel to access funds, So in any case, Scott, if you wouldn't mind, go ahead and it's a great group, usually very active. We can just keep it, like an informal conversation. If you do have anything to show, let me know and we can promote you. I need, a slide, a picture, a graph, anything like that. Just say, hey, Gary, if you can promote me, that'd be great. But other than that, if you wouldn't mind, kind of fill people in a little about the mystery behind Scott Smith.
All right, great. Well, first of all, thanks to everybody for joining. Thanks to Gary and Beverly for having me on. And I wanted to talk about, excuse me, why should you think about reverse mortgages in selling real estate, whether it's investment real estate, traditional real estate, and kind of lay a foundation on that, and then maybe talk about some different ways that you could perhaps use this to grow your business. And particularly in today's environment where there's less transactions available and a lot of people are hustling to find ways to put transactions together, I think it makes more sense than ever to understand it. And I want to introduce myself because I work a little bit differently than most lenders. So I'm based in Gilbert, Arizona. My team can lend in all 49 states, all the states except for New York. And we operate a little differently. So we have the ability to shop 130 lenders, not just for the lowest interest rates, but the lowest cost. Most lenders charge about $1,800 in lender fees, and we can pay all that for you. And then we get rid of all the levels of management. So we regularly save people 0.5% or more on the interest rate and thousands of dollars at closing. So we do traditional loans, and the reverse mortgage is one of the tools that I use a lot to educate realtors. Okay, what are some of the opportunities that you may be missing out on some sales now? So can we just talk about this real quick? Like, I love that Gary said he had some negative thoughts about reverse mortgages based on a transaction he was in, and he didn't really give it much thought. And almost all of the reverse mortgage business that I do it's all personal referral, either a client who's gotten one, a realtor who understands the concept, a financial planner, or a CPA. And we do a lot of these in terms of, and that's how I met Gary. It was a financial planner who connected me to him because we use them in conjunction with strategies to build wealth for clients. So can we just talk about reverse mortgages for a minute? Is there anybody here who's got an opinion of reverse mortgage, good or bad? Anybody? Come on, I'd love some feedback.
I'm still with Gary on his initial thoughts, because I know we saw a little bit about this on one of the other calls. I've never experienced anyone having any experience with it recently. So I'm still like, I just haven't experienced it yet. So I'm interested.
I love that you say that, because a lot of people are just like, I don't like it. And when I ask why, they're like, I don't know, it's bad. So somebody else on the call must have a negative impression of reverse mortgages, right? Anybody out there with, like Jeff, I see you nodding. Do you have a negative impression of reverse mortgages? No. Anybody have any impression, good or bad?
Well, this is Kay, and
Kay, you just accidentally muted yourself.
can you hear me now?
Yeah.
There you are. Yeah.
Okay. I mean, my husband's a financial planner, and my experience has been, hold on a minute, let me order my chicken. I need 12 pieces of extra crispy, please. That's all. Okay, are you there? I'm sorry.
Yeah.
Yep.
Go ahead.
I'm trying to multitask.
Okay.
Anyway, my husband's a financial planner. He's very much against them. the impression I have is, they're just a way for someone to get your home, and that they charge high rates. And then based on the one that I've got, this house that had a reverse mortgage, they tack on like daily interest rates for every day you don't pay it back. And the interest, I'm trying to figure out how much they borrowed. And the interest right now is like $124,000. So I have a very negative impression of reverse mortgages.
Perfect. Thank you for saying that. So she said a couple things that really jump out at me as some of the key objections we need to overcome. So, she was saying that her husband's a financial planner and he believes it's just a way for the bank to get the mortgage. So let's talk about that for a minute, because I think some of the misconceptions around reverse mortgages keep people from learning about them. So first of all, the client always stays on title. The bank never goes on title. And just like any other mortgage, there's a payment, but with the reverse mortgage, you're not required to make it. So it's deferred, or it adds interest on. And with any mortgage, when you go to pay it off, the payoff is prorated to the day, whether it's a forward mortgage or a reverse mortgage. So one of the things that's a misconception about this loan is that when you're done with the house, the bank takes the house, and that's not true. Okay. In fact, it's just like any other mortgage. When it's time to sell the house, you list the house, sell the house, pay the realtors, pay off the mortgage, and you keep the proceeds. Okay. And in fact, the loan is designed so that if the market appreciates at 4% per year and you never make a monthly payment, that when you go to sell, you'll have more equity than when you buy. Okay. So there's a lot of misconceptions out there that we need to tackle. And some of the misconceptions were accurate with the mortgages that were done 15 or 20 years ago. But just like there's been a lot of change in the housing market due to the market crash in 2008 to 2011 and the regulations around mortgages, reverse mortgages are really different now. And what I'd love to do is I'd love to teach you guys about reverse mortgage, just some of the basics. And then once we've covered some of the basics, we can talk about how we can use this for some higher end transactions or some financial planning and integrating this into an investment real estate strategy, or using real estate to build wealth. And so I just want to talk about that real quick, because I don't think that enough of the advisors that we work with, whether they're realtors or financial planners or whoever, are doing a good job of educating clients on why does it make sense to hold real estate either personally or as an investment. And some of the reasons, I just made a couple quick notes, are we all understand appreciation, right? I mean, if we just get 5% appreciation on a $400,000 house, we're adding $20,000 a year in household value. But what people often lose sight of is that you get leverage with this real estate, whether it's investment or personal ownership. An example of that is, let's say that you put 20% down payment on a $400,000 house. You're putting $80,000 down, but if it goes up 5% per year, or $20,000 in appreciation, that's 25% return on investment. And then you should get some cash flow, right? And the cash flow might be that you're renting a house and you're collecting cash above and beyond, or if you're an owner occupant, it might be that you're fixing your monthly payment while hopefully your income goes up and inflation makes your money worth less over time. Okay. And then we got to love the fact that if it's investment property, your payment stays fixed while the rent always goes up. And of course, with every type of loan, you have an amortization. With a traditional loan, every time you make a payment, you're paying down principal, and that reduces the value of the loan, or reduces what you owe, and it's money in your pocket. So we need to be able to take these benefits to clients, help them understand the value of owning real estate, whether it's owner occupied or investment. And what I'd like to do today is I'd like to teach you a little bit about how the reverse mortgage works. And Gary, I do have some slides. Can I share my screen here? I think, let me try.
Yeah,
No, I need permission for that.
Yep. So let me make you co-host. Okay, you should be able to do that.
Okay, great. So let me give that a go. And okay, and let me just pull this up. And what I want to do is I want to give you guys the overview so that you can learn about reverse mortgages. And oops, hold on, let me get out of here and get this right. and hopefully spot some opportunities, whether they're for people to buy them to own or occupy them, or whether or not the opportunity is to buy them as a second home or an investment property. And before we get to second home and investment property purchases, I kind of need to teach you an overview on this. And I would love to encourage everyone to please ask questions, because I want to make sure I'm doing a good job describing this and you've got your brain wrapped around it. And if it's something that we're going to cover later in the presentation, I'll say, hey, let me come back to that. If it's something that's not clear, I'd love it if you just speak up and we'll tackle it then, or I'll say, hey, we're going to get there. Okay. So most people don't know that you can use the HECM for purchase. So let's talk about what a HECM is. So the HECM is the home equity conversion mortgage. It's the federal government's version of the reverse. Okay. And it's backed by FHA. And most of you know FHA is the Federal Housing Administration. It's overseen by HUD, Housing and Urban Development. So this is the most conservative, safest, lowest rate, typically lowest cost mortgage. Okay. And it's called the HECM. And it's important to point out because there are some reverse mortgages that are not backed by the federal government and are not as safe. And those sometimes are what you hear horror stories about. Okay. So a couple quick things. So let's just talk about the basics. Most people don't realize that you can actually purchase a house with a reverse mortgage. Okay. Most people think of this as a refinance tool. It can be used as a refinance tool, but it can also be used as a purchase. Sometimes we refinance these to get cash back for people to buy an investment property. Sometimes we help them with a strategy where maybe they sell their current house to unlock some equity and get the primary residence that they really want, and maybe some cash back for a purchase or a second home. So there's a lot of strategies that we're going to unpack here. One of the strategies that we may unpack is if somebody owns a house and it's free and clear, or they have a ton of equity, maybe we do a reverse mortgage refinance on their primary residence to be able to get them the cash to be able to put down on a new house. Okay, so we can create some leverage by unlocking the equity in their current house using a reverse mortgage. And again, there's different strategies we can use, but we need to go ahead and wrap our brain around how it works, and then we can look at some case studies. So,
Hey, Scott.
yeah.
Real quick, I'm sorry. The number 4, the non-recourse feature. I was surprised to see that. I mean, normally I see that when a house is in a trust, or it's or a house is inside of an IRA. But is that? I mean, my understanding is that means in the case of default, the lender can't come and call in the note or get the house. Is that true, or is there another meaning in this
Yes,
regard?
what you're saying is true. And so the loan that's backed by FHA is a great tool. It's backed by the full faith and credit of the United States government. And the non-recourse means several things in this case, Gary. I'm glad you brought that up. It means that if for any reason you get a reverse mortgage on your house, and let's say that the housing market collapses, goes all the way down to the value of your house is 0, which is unimaginable, right? It doesn't matter. You can stay in the house forever with the reverse mortgage. And if and when you choose to sell it, you sell it for market value. You give the proceeds to the lender. They consider it paid in full. It's non-recourse. Neither you nor your family is responsible for any shortage.
Yeah, that is a way different than 20 years ago. That's a huge,
Yes.
step in the right direction. Okay.
And I love that you
Yeah.
brought that up, right? Because again, it goes to the misconceptions of the loan. And what we need to do is get people comfortable with these. So again, we may use the reverse mortgage as a tool to buy a new house. Like maybe they sell their current, unlock the equity, and they buy a new primary and a new investment. Maybe they own their house free and clear or have a ton of equity. We do a refinance to get cash back to buy an investment home or a second mortgage. There's a lot of strategies that we can use here. And maybe it's the kind of thing where we're just educating you on this and you go, you know what? This would really be great for my mom and dad or my aunt or, somebody who's really hasn't saved enough for retirement. So there's a lot of ways we can use this. Okay. So thanks for asking a question, Gary. If anybody else has got some questions, let's point it out. Okay.
Thank you.
Go ahead. Okay. So on this loan, I think most people recognize you don't have to make payments on a reverse mortgage. but it just defers the interest. So with the traditional loan, you pay principal and interest. With this loan, there's no principal repayment and the interest is deferred. And when I say it's deferred, it's added onto the loan. Okay. You still need to pay tax and insurance and HOA. You need to maintain the residence. Okay. It's got to be a primary residence. It's for people 62 and older. If one person in the couple is over 62 and the younger, somebody else is under, that's okay. We can do that. But the amount of equity that they can borrow has to do with interest rates and the age of the youngest borrower. The lower the rates are, the older the borrower is, the more equity they can access. Right now, for younger borrowers with rates where they are, they can access about 40% of their equity. A lot of times I hear that this might be limited to clients of last resort, but I want to point out the 6th point there. We can do these on homes up to 1.1 million. And in fact, we can go higher than that, but they cap the value at 1.1 million. And we have some really cool case stories where I did one where the house was worth $2.9 million. It was free and clear. We did a cash out refinance, got them back just under $1 million. And they bought a second home, a luxury lake home for $1.1 million. So these loans are really great. Once the loan's in place, it cannot be frozen. It cannot be taken away. It's guaranteed by the federal government. Okay. All right. And again, this is possibly addressing how do we unlock the home equity in the primary residence to maybe achieve some other goals, such as an investment purchase, second home, liquidity, whatever the goal is. Okay. A couple misconceptions of the loan that are very common. The bank never gets the home unless you're upside down and you want to sell it. Okay. But if you're upside down for any reason and you want to stay there, it doesn't matter. You can live there until your age 150 contractually. Non-recourse loan, you never owe more than the house is worth. All the extra equity goes to the family or the estate. If for any reason, again, the house is worth less than you owe, you can stay, never have to make a payment on principal or interest. Okay. And that's backed by the full faith and credit of the United States government. Okay, so why should you care about this? I think this is really important. So I've got this in the way. I'm trying to move this so it's not blocking the screen. Oops, I went the wrong way. So prior to the millennials, the baby boomers were the largest generation in American history ever. Right now, 10,000 people a day are turning 62 or 65. And that's the target market for who could qualify for a reverse mortgage. And by 2030, 7 years from now, that second largest generation will all be 65 or older. And people 62 and over have 12.39 trillion in housing wealth or equity. And when I came across that statistic like a year ago, I'm like, I don't know what that means. Like, I don't know how much a trillion is. So I tried to find some perspective. And the total mortgage market in all of the United States, total mortgage value is 11.9 trillion. So seniors have more equity than the total mortgage value in America. So there's a ton of money out there, okay, in equity that we should be talking to our clients about how to unlock if they're over 62. Okay, here's a quick look at the history of this. The first reverse mortgage was done in 1960. They just introduced the purchase program in 2009. So what's that, 14 years old? A lot of people don't know about it. And now they've raised the mortgage limit or the house value limit up to $1,089,000. So we can do some pretty cool things with this as a tool for your clients. Okay, that slide I skipped. A lot of boomers are moving. I think a lot of people think that retirees get into retirement and they're not moving anymore, but there's a lot of moving out there. 51% of them are downsizing, but a third of them are upsizing. And I've seen a lot of that in the 4 years that I've been doing a lot of reverse mortgages. And a lot of times people get to this phase of their life and they're like, hey, the kids are taken care of. I'm close to retirement. I've got enough money in the bank. It's time for me. Like, I want the house I want. So we're seeing a lot of clients actually moving up. And so we've got some reasons here why they move. And sometimes that move up is about getting closer to the grandkids, and they're moving out of a lower cost market into a higher cost market. And sometimes the reverse mortgage can be an important tool, and we'll look at that. Okay, I'm going to skip that. A couple things to know. In order to do a reverse mortgage, they need a phone call that we call HUD counseling. It's 45 minutes. They got to make sure that they understand the loan, that the client's got the competency to be able to make a decision. But I want to talk about qualifying. This loan uses a residual income test to qualify. Has anybody here on the call ever had a client who's got plenty of money? Let's say they've got $2 million in the bank, but it's hard to qualify them for a loan because they don't have enough income. Has that ever happened? Somebody say yes. It's out there. I run into it a lot. And the reverse mortgage allows you to qualify with way less income. And one of the things to keep in mind is that when families retire, if you've got two income streams and they're both Social Security, when one person dies, you're left with one income stream. So it's not uncommon that a family will have one Social Security stream of $2,500 and one for like $2,000. Maybe they got $4,500 household income. And when somebody dies, mom or dad, you lose whichever Social Security is less. So now that family might only have $2,500 in income. Well, with the reverse mortgage, there's not a debt to income test. With a traditional loan, you need to have enough income that the debt in your car loans, your credit cards, your new purchase, all of that's less than 50% of your income. Well, with the reverse mortgage, that's not true. You only need enough to be able to cover your tax, insurance, HOA payment, and then whatever debt's on your credit report. So, and then have $600 a month left over. So it's not uncommon that somebody who's only got $1,500 a month in Social Security income, that we can qualify them for a $500,000, $600,000, even $700,000 purchase. So sometimes there may be purchases that are getting turned down because they don't have income, that if they're over 62 could qualify for a reverse mortgage. Okay. Okay. So it's a big market and we need to be aware of it. Okay. Any questions so far?
I have a question. What does a reverse mortgage do to your credit score? Because I've been told that if you have a reverse mortgage, you can't get enough credit to buy a toothbrush.
Oh, no kidding. I've never heard that. So the reverse mortgage has no impact on the credit because it doesn't report, because there's no payment. So
Okay.
there's no impact at all on the credit other than a credit inquiry, and the effect of a credit inquiry is really minor. So good question.
Okay.
I'm glad you asked. Okay. And that's another thing that's nice, particularly for seniors who may have less income or they've got plenty of assets, but they're worried about making their money last their whole life. So this is nice because you eliminate the payment for their principal and interest. Okay. Other questions?
What do you want? What do I'm not? I don't want to talk. I need to focus.
I have a question.
Okay.
What do you not understand?
What,
I just don't understand. You don't listen to anything I
poor Kay.
She was not talking to us, right?
No, she wasn't.
No.
Um, a lot of elderly people end up having to get assistance. If they have a home, sometimes that can become in jeopardy. How does that fit in? Do you have any idea?
Yeah, it's interesting that you say that. So it's hard to unpack exactly because there's so many different angles to that. So if somebody owns a home free and clear, then that can be treated as an asset, which can affect their ability to qualify for different programs. It can also be, somebody can put a lien on that. So the reverse mortgage can be helpful in that it puts a lien on the house. If it's a house that they own free and clear, or they've got a small mortgage and they're refinancing to access more equity, it can actually be a blessing because they can get a line of credit attached to the house that does not defer interest, and that allows them to pay for assisted living or in-home medical care And we do use it as a tool that way sometimes. As a matter of fact, it's not uncommon. I'd say maybe 20% of the reverse mortgages that we do are somebody all of a sudden has a significant medical need, or they have concerns that they're going to have one in the future. Like I just started one today for an 83-year-old who just got a diagnosis. They're not exactly sure how it looks. She's not sure how she's going to pay for it, but she owned her $450,000 house free and clear. So we're able to unlock about, I think it was $224,000 in equity for her. So does that help your question?
It does. Thank you.
Okay, yeah. How do you say your name? Juan, is that how you say it?
Juan, yeah.
She's got her hand raised.
Yeah, yes.
Yeah.
My question is, I actually have a house under contract that is a reverse mortgage. The seller passed away. And so we haven't been able to close on it because, and it's with Mutual of Omaha. And they have turned in the documentation. I can't remember the name of the document that you turn in for them to get the payoff. And so they filled out that documentation. Then they also, the listing agent got a hold of someone else and she filled out another 4-page form. The seller's daughter filled that out. And we still have not been able to close because Mutual of Omaha will not release the payoff.
That's interesting. So I want to make sure I've got it right. So you're working with the buyer and the seller's unable to get the payoff. Do I understand that correct?
Correct. And even before she passed, before the seller passed, she was not able to get the payoff from them. And now, that may have been because the right forms were not filled out. But however, now the right forms have been filled out. I know someone also that helped someone to get the payoff on theirs. And once they submitted that form, and they was with a different mortgage company, they weren't with Mutual Omaha, but it was that same documentation that Mutual Omaha required the seller to fill out that this other mortgage company required. So I guess they all go to a certain center or place. And so they were able to get the payoff like in 24 to 48 hours. And we've sent in that form, and then they had them send in another 4-page form. And this has been going on for like, 4 months now, I guess.
Oh my gosh.
Or longer.
That's really unusual. Let me ask you this. Did you say that the seller died?
Yes, she did. She passed.
Okay, so one of the things that the mortgage lenders want you to do is when the seller dies, they want you to communicate and they want you to say, hey, the seller's died and here's what we're going to do with the property. Ideally, they would like you to list the property or refinance or pay it off within 90 days. What I'm guessing happened, and I don't know for sure, Juan, because obviously I'm not part of this, but my guess is that they moved forward without letting the lender know that the seller had passed. And if you think about this, this is different than a traditional mortgage, because with a traditional mortgage, you make a payment every month. And if you don't, the lender calls you, right? Or the lender's like, hey, what's going on? Where's our payment? Well, there's no payment made here. So it's possible that the seller has passed and they were not notified. And now they need to sort out issues about who owns the property or how's it held in trust or something like that. But as far as getting a payoff goes, it should be really straightforward. But my guess is that there's some issues with the trust or the will or probate or something like that. And I think that's holding up the payoff as opposed to the fact that it's a reverse mortgage.
Okay, well, the seller was selling it before she passed. We got under contract with her before she passed. And actually she passed like 2 days before we were supposed to close.
So did that?
And so, but the reason we couldn't, we weren't going to be able to close on time anyway, because the seller was trying to get the payoff from them and she could not get the payoff. And then, so the judge has given,
so
the
you're in
judge has
probate.
approved I'm sorry.
So you're in probate. That's the only time a judge.
Yeah, the
gets-
judge has approved the probate. So we've gotten, the daughter has been appointed special administrator, and all of that has been approved.
Yep. So the issues that you're talking about are all accurate, but they have to do with the house going into probate, which is an issue that you're going to deal with, whether you're dealing with a reverse or a forward mortgage. But yeah, once you get into probate, there are challenges for sure. So I think that's what you're experiencing. I can't speak to it, but I've certainly seen several times where people have sold a house with a reverse mortgage, and it's just as straightforward as selling a traditional home or a home with a traditional mortgage. So anybody else have some questions before I start showing you some examples?
Did you know that you can participate in class every Monday? We call it Monday Night Live, 7 p.m. Eastern, with me and dozens of other investor agents from around the country, in fact, the world. Every Monday, totally free. No selling, no recruiting, just straight up education on anything and everything in real estate. And we have a lot of good guests coming on once or twice a month, bringing in expertise on subjects like how to buy a house with crypto. Okay, how about them apples? What about AI? How's AI affecting our business? How about the metaverse, blockchain processing? We're already using it in title work. So come on to Monday Night Live. Be ready to take notes and ask questions because it's live and engaging, and you get to participate by asking questions and meeting others. So we'll see you there. Go to realestateWithGaryWilson.com. Click on the resource tab, drop down, and you'll see Monday Night Live. And in there, you can see one of the most recent classes. But more importantly, you can register for class as many as you want going up to like the end of the year, I believe. So in any case, do that. We'll see you on Monday Night Live. Look forward to meeting you in person. Take care.
Okay.
Let me check the chat box here. Oh, somebody's asking if interest rates are comparable to a regular mortgage.
Yeah, they are. They're right in the same ballpark. And it's important to note that interest rates really vary from lender to lender. Matter of fact, I had a client who came to me just recently and said, hey, you know, I'm interested in a reverse mortgage, but I think 8.4% is really high. And I said, yeah, me too. You know, who had told you that? And she had said, well, I talked to somebody at Mutual of Omaha. And so anyhow, I got her information. I put together some options, and we offered her a loan at 7.3 or 7.6%. And, you know, she's like, well, where's the difference? And I'm like, well, you know, when you call a 1-800 number, you got to pay, you know, the person answering the phone, that loan officer, the branch manager, the regional manager, the district manager, the executive team, and the owners. We get rid of all those layers of management. When we do a loan, you pay the company, we pay the processing, underwriting, and then we keep a commission. So our rates are lower than what's out there in general. But yes, reverse mortgage rates are real similar to traditional mortgage loans. Other questions before I go through some more things?
Hey, Jim, just one more thing. Juwan's been really doing a wonderful job with this transaction. And thanks, Juwan, for sharing that too, by the way. But if you happen to know anybody at Mutual of Omaha, just to contact, just to make an introduction, we'd really help because we work at our wit's end. And we tried everything, and the judge has proved everything. And it's almost like we have to sue them or something. We can't figure it out. It's just we're baffled, you know. So,
Yeah, I actually work pretty closely with Mutual of Omaha, and when we get done, I'm gonna have my contact information on the slide. So
okay.
if you guys want to go ahead and write that down or take a picture of it or whatever, either call me or email me, and yeah, I'd love to help you get connected and sort through it. Okay.
Yeah, that'd be wonderful.
Okay.
All right. Thank you.
Yeah, you bet. So when somebody is done using the house, or if they pass, it's just like any other transaction. You sell the home, pay off the loan, you keep the proceeds. Okay. If for any reason they're upside down, which is very rare, but if it does happen, sell the home, give the proceeds to the lender, they consider it paid in full. Okay. And that, again, it's a non-recourse loan, so it doesn't hurt their credit or anybody else's. Okay.
So real estate fees just come out in typical transaction format?
Yep. Just like anything, it's literally like any other sale, in that you establish a purchase price, you pay whatever the fees are, whether they're realtor commissions, title fees, you know, prorated taxes and insurance, you pay off the loan, and the seller or the estate keeps the proceeds. Yep.
Thank you.
Yeah, you bet. So a couple quick things. This is for primary residences. And And I want to give you guys some scenarios to talk about how you could perhaps use this to grow your business. It's good for 1 to 4 unit properties, manufactured homes, FHA approved condos, homes in HOAs, townhouses, properties in a trust, just about any property out there. Okay. Couple things to know. There's no seller concessions allowed. There's no realtor credits allowed. Sometimes they underwrite the home inspection. You can have sellers being a trust, or it could be the will. We pre-qualify people for these loans right up front, just like any other purchase. Okay, I'm going to skip past the new build process. The new builds are a little different, and I can help you with any of these. So let's do some examples of how to put this to work. Okay, this is all the numbers. This is compliant, but I think the math's hard to track, and I don't like tons of numbers. Let's make it simple. Let's say that we've got a client who wants to sell the house on the left for $450,000. Let's say they have 6% in commissions and costs, et cetera, and they own it free and clear. So at closing, they get back $423,000. Well, one thing they could do is they could sell that house for $450,000, take the proceeds of $423,000, and instead of buying another house for cash for only $423,000, they could go get the house of their dreams and buy a house for $770,000. They would need a $422,000 down payment. They would own a house with 0 principal and interest payment, and the mortgage note, which is backed by FHA, Federal Housing Authority, guarantees they can stay up till they're 150 years old. They got complete peace of mind around ownership. All they have to do is pay tax and insurance and HOA. So that's one way that you could use this. Okay. You could also downsize with this and free up some cash. I think this is where you're going to find it really interesting. So this same scenario here, where somebody sells a house for $450,000, let's say that maybe it's a 2-story home, or they live there with their husband or their wife, and one of them has passed and it's time for a fresh start, or the home's got deferred maintenance, or it's just not right for them. The neighborhood's not where they want to be. So they could sell the home for $450,000, again, have 6% in closing costs, realtor fees, whatever. Buy a new house for $450,000, but they only need to put $250,000 down. And now they've got $173,000 of equity that they've unlocked, and they could either use that to increase their cash position for retirement, or they could use $173,000 as a down payment on a new house that they want to buy, or an investment property, and they would have a new house that's right size for them at this point in their life, and they could have an investment property that's generating cash flow for them and building appreciation and giving them a tax write-off. And I absolutely love this strategy, and it's something that I don't hear realtors talking about. Okay, any questions about how that would look?
Okay, so they're going to sell the first one, buy another one for the same price, but this case, they're putting down obviously a giant down payment, the balance they put in the bank. Okay.
Yep. And so a bunch of different strategies that you could use here. Either they've got a bunch of cash for retirement, or they've got a bunch of cash to go buy a second home or an investment property.
Okay.
Okay. All right. Here's another one. A similar strategy, but I want to show you a couple strategies to get your brain working and to spot opportunities. So we've got the same $450,000 house. You could go ahead and sell the $450,000 house. You could have them buy a new house for $600,000, have them put $372,000 down, and they've got $50,000 left over. So let's just take a minute to unpack these. You know, with each of these strategies, we're talking about somebody who's got a house free and clear, and it's not the right house for their time in their life, but they love that it's free and clear and they don't have a payment. And maybe, although they're house equity rich, they don't have the house that they want. Maybe they don't have the cash flow that they want, and they can't go buy another house for the value of what their house is worth after they sell. So this allows them to buy a new house, make a 60% down payment, and free up a bunch of cash. So now all of a sudden we're talking about an opportunity where maybe there wasn't a sale opportunity because they didn't know how they'd buy the next house, but now you're selling for $450,000. You're helping them buy a new house for $500,000 or $600,000. Now you've got 2 transactions for $1 million. Maybe you're generating $20,000, $25,000 in commissionable income, and you've got $50,000 left, which perhaps you could use as a down payment on a $250,000 condo purchase. I can't understand
Okay.
whoever's talking. But looks like Todd's got a question. Todd, questions, thoughts? Okay, anybody else have a question or thought on this?
Hey, hang on, I just,
Sorry,
Um,
I was not able to. Can you hear me now?
Yeah,
So in that middle scenario where you sell the home for $450,000, you purchase a $600,000 house with this down payment. What is this payment? What are these people paying per month now to live there?
I'm so glad you said that, because apparently I didn't make it clear. They don't have to pay principal, they don't have to pay interest. So the only thing they have to pay is tax, insurance, and HOA. So obviously a $600,000 house, the tax and insurance is going to vary per market. But you know, what are the tax, insurance, and HOA in the Arizona market where I work a lot? You know, maybe that's $300-400 a month. So it's a very cool strategy.
yeah. Hey, Scott, I just realized something. There are a couple of new agents on the team, so we have a whole spectrum, brand new agents to seasoned veterans, and some are investors too. But so Brittany just brought something up. Would you mind giving just a basic distinction between a traditional mortgage and the flow, the flow of money and all that, and then explain the reverse mortgage, and that might help the comprehension. Because I remember when I first learned it, I was like, I was baffled too, 20-25 years ago. But
Okay.
yeah.
So are you asking me to compare a reverse mortgage to a traditional mortgage?
Yeah. Brittany asked a question. We actually have several brand new agents on the team, and this could be. I remember for me when it first came out, I thought it was. I just didn't get it at first,
Okay.
So yeah.
So let's talk about that. So with a traditional mortgage, you make a down payment. It varies. It could be 5%, 10%, 20%, or more. And then once you've made a down payment on the house and paid your closing costs, then you get into what's your monthly payment. And a monthly payment is composed of paying principal, interest, sometimes mortgage insurance if you don't make 20% down payment, and then taxes and insurance. Okay. So again, with a traditional mortgage, you make a regular down payment, and then you have a 30-year, typically it's a 30-year mortgage, you have a 30-year commitment to make 360 payments where you pay principal, interest, mortgage insurance, potentially taxes and insurance. With a reverse mortgage, you make a large down payment to buy the house if you're doing a purchase. It's right now, it's currently about 60% down payment, but then you only have to pay tax and insurance and then HOA if there is one. And again, the reverse mortgage allows you to live in the house without a payment for the rest of your life. The only thing they ask that you pay is the taxes, insurance, and HOA. It has to be your primary residence. You have to be 62 years old, and you can't leave the house for more than 12 months. So if somebody goes into assisted living, and they're the only ones that live there, they've got to be back in the house within 12 months or sell it or refinance. If 2 people are in the house and one goes into assisted living, that's fine. Did I answer the
Yeah.
question, Gary?
Scott, I have a further add on to that. I just curious for the middle home that that we're buying for 600,000,
Yep.
372,536 down. Who's paying that seller the other $227,000 that's owed to them
Great question.
to make them
Excellent.
whole
Thank
on
you.
600,000?
That would be the new mortgage. So that's a perfect question, and it's a shortcoming. I should have that on this slide, right? So let's do this slide again. So in this example, they'd sell a house for $450,000 that they owe free and clear. no mortgage on the house they're selling, this one over here. They pay 6% transaction fees, commissions, closing costs, whatever. They get back $423,000. With the new house that you mentioned, Gary, they're buying for $600,000. They're going to make a $372,000 down payment, and the reverse mortgage would be for the additional $233,000. And that reverse mortgage does not require a monthly principal or interest payment. Does that help?
So Brittany, the reverse mortgage company like Mutual of Omaha, they're giving the seller of that middle home the other 200 and whatever it is, 270 something thousand.
33,000.
Yeah.
And
But
what's
the owners here, the buyers don't actually have to pay on that. They don't have to pay that mortgage down, because that's one of the benefits of reverse mortgage is the bank's actually kind of holding that note until they either, pass away, sell the house, move, whatever the case is. And then out of those proceeds, that's when this lender's paid back from that portion.
Yep.
Got it. So 10 years down the road, this house has probably got built equity. It's now worth 700,000 or whatever. That's worth more.
Yeah.
It gets sold. The balance of 227,464 gets paid back to Mutual of Omaha. That's when they make their money, and they don't make any interest on this investment. That
I
sounds
love
a
that
little
you're
bit too good to be true.
I love that you're saying that, because I can start to tell when people are wrapping their brain around this, when they're like, wait, what's the catch? Or this is too good to be true.
Yeah.
So the way the lender makes the money is a couple ways. So in this example that we're looking at on the screen, there's a $233,000 mortgage. Every month that a payment is not made, it adds to the balance. So let's say that the interest payment, just to have round numbers, is $1,000 a month. So if the mortgage starts at $233,000, after the first payment is not made, now the balance is $234,000. Then the next month it's $235,000, and then the next month it's $236,000. So the balance of the loan increases by $1,000 a month. So 10 years from now, that house might be worth $1 million, and the mortgage owed might be $500,000. So when that mortgage gets sold, they're going to get all of the interest paid back, and they make their money on the interest like any other mortgage lender. The cost of money for a mortgage lender right now is about 3.5%, and they're lending it at 7.5%. So on Wall Street, they can securitize that. It's the future value of money, and that's an asset that they own. Even though they're not collecting the interest, it will be collected at some point, and that has cash value. That make sense?
Yep.
Okay. So I love that you guys are asking questions, because I feel like I didn't do a great job explaining this. And now some of you, or all of you, a lot of you are starting to wrap your brain around it. So does everybody have their brain wrapped around this specific situation? Do you want me to go back and show you some of the others that we reviewed a couple minutes ago? No?
Well, you have another example. How about one where the property they buy is an income producing property, like a fourplex? I don't know, that might be,
So you can
because they're
absolutely
making money
do
on the new
that.
place.
And let's go back and let's look at,
Okay.
I'm glad you said that. This could be an example of buying a fourplex in a certain market. Okay. In this, wait, actually, I'm going to go back one more. We could use this example right here. Let's say they sell their house for $450,000. They get $432,000 cash back. Now they've got, again, $432,000 cash back. And if I do a little bit of math here, I can reverse engineer this. So if I go 432 divided by 0.4, they could actually buy a fourplex for $1,080,000 with the $432,000 cash back that they got, because basically you need to make, I did that wrong. I'm sorry. Let me do it this way. 432, 1, 2, 3. I'm sorry. They could actually go and buy a fourplex or an income producing property up to $720,000 with a $432,000 down payment. Now, I don't know if it makes sense for somebody to sell their primary residence and unlock $432,000 and go buy a fourplex when they're in the senior phase of their life. But sometimes we can do this with higher value homes. I had talked about this briefly earlier in the call. There's a high-end part of town in Arizona outside of Scottsdale called Paradise Valley. I had a client there who had a house for $2.9 million. He owned it free and clear. He had about $3 million in securities, but he was only 63 years old and he understood financial concepts and he wanted to buy another house as a second home in this specific example. However, he did not want to have a big mortgage, which would eat away at his $3 million for retirement. So because he owned his primary residence free and clear for 2.9 million, we were able to take 1 million cash out, which he could use to buy, in the example Gary said, a fourplex or 2 fourplexes for cash, or he could use them as down payments on a mortgage. So there are ways where we can work with high net worth individuals, use them to free up cash. I can give you any questions on that before I give you another example?
No, I like that. And even with this one here, you know, if they basically bought this a house with the same price, put down a $250,000 down payment, leave that home alone with that mortgage, but take the 173 that they would have put in the bank and put down a 25% down payment on a nice big fourplex that gives them retirement income, right?
Yep.
And growth and equity and all that. And I know if they're, you know, I know investors that are in their 80s and still actively investing. I hope, you know, I hope I would relax more myself by then, but you know, they just keep going, you know, it's amazing.
Yeah, and I think that, you know, Gary, you've been in the game long enough to understand, you know, the value of being able to unlock the home equity, but that's the message that we need to take to the market, right? To realtors as well as clients, like, hey, you've got all this equity trapped in your home. And although your home is an asset, it shows up on the asset side of the balance sheet. It's an underperforming asset because your equity is not liquid. It's maybe not safe if the market collapses. It's not growing. You can't do anything with it, right? So the reverse mortgage is a tool where we can go in, we can either refinance to unlock the equity and they can go buy an investment producing property, which is a hedge against deflation. It's a hedge against running out of money. It's a hedge against the property value going down. Or we could look at, okay, maybe this house isn't right for you. Let's sell this house, unlock the equity, get you into the house you want. And if we could have some extra money left over where we could get you an investment property, that would be amazing. And what it's worth for the realtor is, let's say that somebody owns a house free and clear and it's not right for them, but they don't have a lot of money. They're house rich and cash poor. Well, there's no sale there, right? Because they can't sell and get what they want for that price. But if we could help them sell, make a 60% down payment and buy the house that they want, and then use the rest of the cash to buy an investment property, maybe you just created 3 sales. So maybe we should be looking for people that own their house free and clear. And 60% of homes owned by seniors are free and clear.
Yeah. I mean, even if it's in its simplest terms, if someone is 60 years old or, you know, and owns their house free and clear, instead of getting a home equity loan or line of credit to make a down payment on a fourplex, they get the reverse mortgage, right? Where they actually don't have a payment.
Yep.
And then they have, when they put that money that they get out, it's the down payment on the income producing property, that's more cash flow for them.
Yeah.
Right.
With the home equity
that's what I'm saying.
The home equity line of credit is commonly used, but it's interest only for 10 years. And then the last 20 years, principal and interest. And it's, you know, your payment could go from $800 a month interest only to $1,600 a month with principal and interest on a 20-year loan. Whereas, like Gary said, with the reverse, you don't have a payment. So you really have to open up your mind and start looking at the different ways this could work for you potentially.
Well, here's the rationalization for it. It's plain simple economics. Is home values have gone up a lot over the last couple of years, so they will be tapping into a higher level of value on their existing home. And we know the rental market's been increasing every single year for the last generation. I mean, the percentage of home ownership is dropping rapidly. And even 2011's when Warren Buffett said, if he could buy 100,000 single family homes and rent them out, he'd do it. And he didn't do that. He bought Prudential Realty. But the point is the percentage of ownership is dropping rapidly because more people are becoming renters. So they could tap into a resource that's necessary in our economy right now, will be for the foreseeable future. And all the rents are going up too. I mean,
Yes.
that's the pitch for the real estate agents to use with their clients. And they get at least one sale out of it, you know, to boot.
Yeah, and it's getting to be where homeowners are competing with Wall Street to buy houses, right? And
Mhm.
the competition for rent, the competition to buy starter homes is tough. And if you can unlock the equity with a reverse mortgage and make a big down payment or buy the house outright for cash, it's going to put you in a stronger position. And Gary's point about rents going up and us becoming more a nation of renters makes investment property even more attractive, because rents are just going to keep going up as Wall Street controls more and more of our housing inventory. And it's harder to get into a house as prices go up. It's really tough. So any questions on this, guys? I really appreciate your time. I know we
Yeah.
covered a lot of ground. I'd love to answer more questions.
Yeah, Scott, I wanted to just clarify, make sure I understand it as well. So if when the couple, if they lived there for, another 20 years, whatever, and they did, and they both passed away, if there's still equity in the property sold or whatever goes to their heirs, and the money, the equity goes to their heirs, and the bank gets paid off just with the balances, correct?
Yeah, correct. It's
And
literally like any other mortgage. You list the house, you
Yeah.
pay the closing costs, the realtor commissions, the title fees, you pay off the loan, and whatever equity's left, the family keeps.
And if there is not equity and they're upside down in the house because they never paid a payment, say the market dropped,
Yep.
and there is not any equity in the property and they owe $100,000 more than what it's worth. Did I understand you correctly saying the bank takes the house and there's no penalty, they don't owe any
Correct.
more?
Yep. So Gary commented early on that it's a non-recourse loan.
Hmm.
So the non-recourse loan is a great feature. What it says is that if you're ever upside down in the house, you can stay as long as you want. And that if you're upside down when it's time to sell the house for market value, pay the realtors, pay your transaction costs, whatever's left, pay to the lender. They consider it paid in full, no recourse for you as a seller or for your family. It's pretty amazing.
So I'm assuming that just
Yeah.
doesn't happen very often, or they wouldn't do it.
Exactly correct. And it's gotten more conservative over time. And one of the things that's hard to wrap your brain around is right now, they'll only lend you about 40% of the house's value or let you cash out 40%. And it's based on the assumption that the houses are going to continue to appreciate at 4% per year. And I think that sometimes a visual is helpful. So let's say a reverse mortgage, you don't make a payment and the balance goes up slowly like that over time. So this mortgage is 40% of the house's value and it's going up slowly. But you're getting appreciation on the whole home. So the value is going up at the same time your loan goes up. So your equity, in theory, continues to grow, or the equity is still available for you. And that's if it just appreciates at 4% per year. And that's based on current interest rates or lower. If interest rates got a lot higher, it might look different. But regardless, the mortgage note says you can stay until you're 150 years old, as long as it's your primary residence, regardless of the value.
Thank you.
It's a lot to wrap your
Yeah.
brain around, right? It's like a total different mindset. And I love these questions because it hopefully is expanding your thinking. And so if you guys want to figure out how this might look for you and a client, my information's on the screen. That's my cell phone number. I've done this for 21 years. My email address is there. I'm licensed in Arizona and California. I have a partner who's licensed in the other 47 states. And I'd love to help you figure out a specific scenario. Juan, there's my information. If you want to shoot me a quick email, I will see if I can't connect you with somebody at Mutual of Omaha that will help. And I can help with traditional loans too, regular forward mortgages. And we do some loans that nobody else does, like loans for people with no income, people with assets but no income, investment properties where we lend off of the rental income of the home. So even if the person's unemployed, they can buy an investment property. We do entrepreneur loans where if they don't show income on their taxes, we'll lend off their bank statements. So we have some creative solutions to help our realtor partners. Okay, any other questions? I don't want to take up any more time than necessary, but I love to answer questions.
Yeah, and while you guys are taking any questions, I just want to say thanks, and also thanks to the guests that are on tonight. I know there was Todd. Let me go back to the list here because we appreciate when we have guests. So Todd, let's see. Well, Henry's on. Henry's a brand new agent. Les, Kevin, and there's another person. Hang on one second. I'm trying to think. Oh, Lindsay. I'm sorry, Lindsay Jones. So thanks for the guest. And for the guest, we do this every Monday. You can participate just like Todd did. You can ask questions just like the agents on the team. We are here to educate. If you're ever interested in learning about the team and or talking to members of the team, they're all on here. You can just put in your name and your number, or ask them for their name and number, and you can call them and talk to the members of the team too. So, and I will stay on too for a little bit if you guys have questions on this or anything else. As long as you're active and asking questions, I'll stay on till about 8:30 Eastern when I have to have some dessert. Yeah, that's my famous line, Scott, at the end. But Scott, thanks again for doing this. I knew once you came on and we got started, it would generate a lot of engagement, because it's when you think about the potential here, like you did a great job of going from the old school of thought and the old mindset to the real possibilities. So just like anything in life, anything can be used for good or bad. And this case is a really good example of how we can use this for good. I'm totally unaware of the non-recourse part. That is a giant help for a lot of people. Big step in the right direction as far as community service goes. I'm just blown away by that,
Yeah, it's a great tool. And, a lot of times, one of the things I didn't mention is maybe you're working with somebody who wants to buy a house for cash and they can't get what they want for cash. And so then we help unpack it. Like, okay, why do you want to buy it for cash? Well, I don't want a payment. Okay, well, do you want to make 100% down payment and you're limited to the cash on hand? Or you want to make a 60% down payment, buy a bigger house, maybe have a little cash left over to move and not have a payment? And if so, let's introduce you to a reverse mortgage. So once you really start to wrap your brain around it, you can really take this a lot of directions. And I'd encourage everybody to write down my information or take a picture of the screen. And if you want to look at a scenario or you want to talk about this more, just reach out and I'll help any way I can. So,
Okay.
And with that said,
Do you have anyone that speaks Spanish?
I do. I have people on my team that speak Spanish. I work closely with a lady named Nicole Perez. She'd be glad to help.
Okay.
And with that said, I don't have dessert, but I've got an appointment in 15 minutes and I got like 4 phone calls to return.
Okay. All right.
All right. I'm going to go ahead and log off, guys.
There's Scott.
Thanks, Scott.
Tell Mike and Shannon I said hello.
Yeah, you got it. I'm actually going to talk to Mike again tomorrow and I'll thank him for introducing me. So let's talk again soon.
Yeah.
And Andre, if you'd like me to share it with your team, I'd love to do that.
All right, sounds good. Thank you.
All right. Bye, everybody.
Okay.
Thank you.
Thanks, Scott. Yeah. Okay, guys, if does anybody have any questions on this or any other subject while we're here? It is 8 o'clock. I understand if you have to go, you have to go. That's the commitment. It's 8 to 1 hour class, but we always stay on. For the guests, we always done a little bit longer, just in case. So you guys like that? Like that subject?
Very
Yeah, very
interesting.
interesting.
Yeah.
I learned a lot
Yeah.
too. I always thought that the house would go back to the bank, that's why they're not paying for it, because the bank's gonna take it. I didn't know about the other part. It's cool.
Yeah. Well, just so you guys understand, non-recourse, what that means is in the case of an upside down situation where the mortgage is more than the value of the house, or the people, whatever, like foreclosure type scenario, they can't come and grab the house.
So they
They
can't take it
That's what
from your heirs.
non-recourse means. No, it's just like if you own a house inside of an IRA, anything inside the IRA is protected. Same thing with a trust. If you own a property inside a trust, it's protected. That's why banks, if you buy a house that you want to put in a trust, sometimes it's better to buy the house first, get a traditional mortgage on it, then put the house in the trust. And there's a clause in this legislation that prevents the banks from calling that no too. It's non-recourse. So that's why people will say, yeah, put a house in a trust, but if you put the house in a trust, when you buy it, you're not going to get a traditional mortgage. You're going to be lucky if you get 65% loan to value, because the bank, if they have to foreclose, they can't come get the house when it's inside a trust. So that's why that's so powerful. And the protection for seniors is, if they do find themselves in a bind, they don't have to worry about them having to leave their house. They can live there till their time is up, and then the bank will deal with it. So I just think that's a big plus for people. So okay. Any questions, guys? Anything you want to talk about?
I had one observation, guy. I may be looking at this cynically too, and I tend to do that.
That's okay. Yeah.
Let's just say I had that first scenario. I got $450,000 house, and I don't necessarily want to upgrade, but I maybe downsize, but I still pay $450 to get my next house because the prices have gone up.
Okay.
And I could live in it. I don't pay any principal, interest. I just pay taxes, and I just pay my HOA. Well, anything, right? Maintenance. At the end of my term, let's say I'm 10 years into that, I leave my family a $450,000 or more asset. At the end of a reverse mortgage, I'm leaving them much less. Correct?
Yeah, you're correct, because the reverse mortgage, remember, that's still the principal balance. Instead of you paying it down, what the reverse means is you're not paying it down, so it's accumulating. The interest is being added
growing
to the principal.
So when I sell that house at the end of, let's say, 10 years, I am not leaving, let's say, my heirs much.
Yeah.
Right.
Yeah. Theoretically, the theory is, you're right. And you're absolutely right. The theory is the house would hopefully go up in value, in a commensurate way. But you're, again, that is one of the risks. That's one of the risks is you stay there a lot longer, right? And the principal keeps accumulating, and it's compounding. Remember, interest compounding. So, 6% on 400,000, that is going to add up, Yeah. But then while you're living there, all that money you would have spent on principal payments and interest payments, you could take all your family to Disney World every year. Yeah. You have, Todd, do you have, if you don't mind me asking, do you have grandkids, or what's
I have two children in their 20s, but I'll just put myself in the little, the gray-haired person in the cartoon there.
Yeah.
Just thinking, if that's an interest of theirs, or they are looking to pass down money to their family, right? Generational wealth. At the end of this reverse mortgage, you just got to keep in mind, you may not be passing down much or anything. So you're almost like pre-spending your inheritance that you would have passed out.
Yeah.
Which is great. I mean,
it's
it's a good option for some people, right? But it is just something to consider, I guess, for others.
Yeah. I mean, some cases, I mean, I'll give you, I don't mind sharing the house that I'm in right now is actually my mother's former house. When we lost my stepdad, all this became, obvious, because I was the executor. I'm like, holy crap. So I told my brother, I said, look, I'll let you buy the house for half price if you want, as long as mom can live there, because they had a reverse mortgage and it accumulated. And thankfully everything worked out, and now she's here with her. The intent was to keep her here. And so now we're taking care of her. It's that stage of life, and everything worked out. At the end of the day, everything's going to be fine. But the ultimate aim was for us to keep her here once we knew what the facts were. We weren't aware. They didn't tell us, and it all came out at the end. And but that's it. But I was actually angry. I was like, I can't believe this. This should be illegal. That was my thought, And I met Scott a month ago, and is he wanted to tell me about how it can be used. And I said, okay, I generally give everybody the opportunity to speak, and I had never thought about it and to be used for investing purposes. And that's our whole team is based on investing and working with investors. Well, we work with owner occupants too, but we have a special platform just for investors and investing. And for me, that's an ideal scenario. Heck, if I can tap into equity in one property, a house to live in, to buy a multifamily and not have to pay on that loan, the, the borrowed money.
Yep.
So, I mean, heck, sign me up,
Good deal. Yeah.
So, yeah. So, I Todd, by the way, nice to meet you, and I appreciate you participating. We really do. We love having guests, not just guest speakers, but guest students. And whoever invited you, please say thank you. And or if you just found us online, please come back, whenever you want,
Forgot how I did find this, but I am new to be an investor. I'm not yet doing it, but I'm getting close.
Okay. Yep.
Thanks for
We got a lot of agents on the call here.
Yeah, is that what all our
These
agents are all
agents are-
real estate agents?
Yeah, most of us are investor agents and in 37 states. So
Oh, wow.
you've got some real winners on here. I mean, I'm telling you, I'm looking at them right now, and all these guys know what they're doing. So we created the team for the purpose of filling that gap, because I know when I was starting to invest years ago, none of the agents were equipped to help me. They're wonderful people. They were not trained to invest or work with investors. So I created this for that purpose specifically,
Great. You do this every week?
Absolutely. Yeah.
All right.
Yep.
Let me know
Every
when you
Monday, we call it Monday Night Live. Yep. 7 p.m. Eastern. And the only time we don't is if it's, Christmas week, that kind of thing, Thanksgiving. But for the most part, it's certainly 48 classes out of the year, if not 50,
Okay.
Yep. And then we teach, so we have 6 training programs, all on investing and flipping, wholesaling, buying rentals, managing rentals, you name it, commercials in there. And then we have mastermind groups where we focus on specific subjects. So that's really what we do. And everybody gets coached one-on-one. Everybody gets one-on-one. So
Great.
Are
yeah,
we
kinda-
doing class next week because of EXPCon?
yeah, we're still going to have class. Let me just give you a little heads up here real quick. And by the way, Todd and everybody, you're going to get an email tomorrow automatically just because you sign up for class. Beverly sends the email out with a recap, basically the recording of the class, and it also tells you what the upcoming classes are. So next week is Neil Timmons, and he's going to talk about taxes, specifically for people who own businesses and investors, which is essentially owning a business. So you definitely want to tap into that one.
Okay.
I mean, I've got this is my opinion, but I've got a pretty good feeling coming down the road. Some of the rules are going to change when it comes to taxes and taxation. I don't want to alarm anybody. It's not my tenure. I just want you to be prepared. So prepared people see the opportunities and adversity. People are not prepared, get scared, So let's learn from Neil. And by the way, let me just elaborate what I was talking about. When I look at legislation and policy at the state level around the country, and it's easy to do because we have agents in almost all the states, there is an absolute trend towards providing housing for renters, and there's no trend for providing housing for homeowners. That's gone by the wayside. For what it's like, they just gave up on it or something. You can look at the policy, and it just tells you right at it's plain as day. Which also means regulation and legislation are going to follow the same line of thought. So you're going to see legislation, regulation leaning towards the tenants. I'm not saying, I'm not judging it. I'm just telling you that's the way it looks like it's going. So some of the things you can look at as far as an exit strategy, what we call a holding strategy, or short-term rentals and midterm rentals, which is your corporate housing. That's your business traveler, traveling nurse. They're going to be there for 6 months. They'll pay double the rate. They're not bringing their families and dogs. They're just coming to work. Sometimes the employer will pay the rent. And when they leave, you don't have any trouble. It's nice and clean and easy. So those are alternative uses for rental properties other than traditional rentals. It's traditional rentals that I was referring to a moment ago. So sorry to go down a rabbit hole here, guys. I just want you to let you know what my observation is. It doesn't mean it's going to happen, but the policy, you can look at what's happening. Look at California, where they're giving incentives for investors and builders to build subsidized rental housing, and they're guaranteeing rent payments, which already happens anyways on subsidized housing, but with one exception. You can't decline people for financial reasons, so that's the last thing that you have as an investor, is why do you invest in to begin with, right? So in any case with that policy there, just look for more of that to happen around the country, particularly in the Northeast, the Rust Belt states, in the Midwest, and I think we'll start to see more of that. It's already happening in Canada, in Ontario, Toronto, very, very strict. So, but all that means is we have to really do our research. It's easy to do. If you're ever interested, Todd, or any of the guests, Lindsay, we can have someone on the team take you into the website and show you some of the tools we use and the research, like your websites where we can find out, we can track the movement of money from state to state and county to county. We can obviously track people. So you can see what's happening. You can see the trends developing, and then as an investor, make much more informed decisions,
Yeah, it
So,
sounds great.
any
Thanks
case-
for inviting me, and appreciate this conversation. Maybe I'll join next week as well.
You got it, man.
Take care.
Okay, guys, if there's no, you too, Todd.
Bye.
Hey, if there's no more questions, guys, I'm gonna go ahead and spend some time with my mom, now that you know her story. And enjoy the evening. I hope you guys do the same. If you haven't had a one-on-one lately, please feel free to set one up. Again, next week, you won't see any time slots open. But if there's something urgent, just like Juan, if something comes up, just call me, text me. I'll call you in between sessions, whatever's necessary. We'll keep the ball rolling. Okay.
Thanks.
Okay. All right. You're welcome, guys. Hey, have an awesome night. Okay. Bye-bye.
Thanks, Gary. Have a good one.
You too.
Thank you for watching this episode of Monday Night Live. Be sure to subscribe to our channel and go to realestatewithgarywilson.com to join our community and start building wealth today.